Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Folks are asking me, is gold a good bet? Because we're not sure it's going to happen with equity markets with continuous conflicting statements, it seems, from the White House.
Yes, gold is I think going to be a good bet. And you know, ever since the 2011 9-year cycle top, you know, I said that gold would go down into 2016-17 into the 9-year cycle low. And as we've been talking here, I've said that the December 2015 low was probably not, December 2015 low was not the low. I mean, it occurred too early. We had a higher low in gold in December of 16, and that's the problem. Looking at the cycles, looking at all the norms, all the statistics, we should have another push back down in gold to complete that 9-year cycle. Like I said, the December 15 low was just way too early. And then with this December low a few months ago occurring above the previous level, the structure's not right. So, you know, until proven otherwise, the statistics and all of the historical norms and the cycles and everything tells us, yes, there should be another push down in gold. And I was looking for it sometime probably in the March, April time frame's what I'm kind of thinking. But that said, you know, on the other hand, I do acknowledge we've had an intermediate term buy signal in gold, and it's not wanting to give up and push down into that. Now, I'm not giving double speak. I'm just acknowledging it is for what it is. I do think at this time, in spite of this intermediate term advance, that there should be another push down. And that said, let me explain why, because the stars are kind of aligned here across the board. When we look at crude oil, you know, we had also a low last year in it was January, February, and crude oil advanced out of that low, and it's still holding. It hasn't corrected that cycle of that degree, that advance. It's held up very, very well. But at the same time, we have those cycle highs due, and we have that same push back down that we're expecting in gold. So, you know, that kind of, the one kind of complements the other, if you will. But then, if you look at the CRB index as a whole, which is a basket of commodities, the low we saw in early 2016 was a low of a higher degree. That was a 3-year cycle low. And, you know, it's advanced out of that low. It peaked, I think it was in June, and then it's kind of flatlined since. Well, it still has the same cyclical push down as well. So again, the cyclical rhythm, they complement each other. And then you tie that to equities. And, you know, we had the low last January, February, on the industrials itself. That was August of 15. But that cycle of that degree, it's at the same high. And so here we sit with pretty much all of these asset classes at that high, cyclical high, what should be that cyclical high. But granted, it hasn't given to the pressure of those cycles that's due. We're still there now. It's still treading water. And until something happens to prove otherwise, the expectation is that, yes, we see that push down across the board with equities, gold, all of it. And, once that happens, then the structure associated with that, with the CRB and gold and everything else, is going to tell us a whole lot and help identify that 9-year cycle. But we do need that push down, and I do expect it, in spite of the fact that it's held up as well as it has.
Gold bugs, of course, are still telling us things are set up to have $5,000 gold, $10,000 gold. Are those numbers impossible or totally improbable?
I'm not going to say that it's impossible or improbable. It sounds crazy, but, crazy stuff does happen when things get in a bubble. And let me say this. I was accused, it's kind of funny, I was accused of being literally I got an email and a guy said I was an enemy to gold. Back whenever, I think it was at the 2008 9-year cycle top, when I said that gold was going to go lower, then an enemy of gold. No, it just is what it is. And so I have no allegiance to or agenda against or for gold, or even equities or anything else for that matter. That said, I have to side with the gold bugs optimistic view once we get to that 9-year cycle low, because once we get to the low, now put your mind around this, the key is here is that this is going to be the highest level in which a 9-year cycle low has ever occurred. And when I say the highest level, I mean, I'm talking about the highest price level, because each of these 9-year cycle lows have occurred at a higher and higher and higher level. And so, is there going to be tremendous opportunity? Yes, absolutely. To what degree? I don't know. I just know that we're setting up for that 9-year cycle low, and once that's in place, the green light is there. Where it goes, who knows? I guess that depends on how crazy things get. But what it is telling us with that 9-year cycle low coming in is that gold is seeing something. I mean, gold rallies when things aren't so good. You know what I mean? It's kind of a, what would you say, a flight to quality type thing because of fear. So I don't know what gold may be sensing, if you will, as it goes into this 9-year, or as it comes out of this 9-year cycle low, but there appears to be something there, and what that is, I don't know, and I guess that depends on how big that bubble is blown, or if it even is a bubble. I mean, maybe it's a little limp rally. I don't know, but the potential is certainly there, yes.
Gold mining shares had a terrific year last year. Will they have the same kind of year this year, or is it even possible because last year was so good?
Well, I think what you typically see, or what I've typically observed at a 9-year cycle low in gold, is that equities, I say equities, the gold mining equities, will bottom ahead of that 9-year cycle low. They tend to confirm the low a little bit ahead of time. And what I'm suspicious of is that maybe we've already seen the low in gold miners. So in other words, while we should see another push back down, I don't look for them to necessarily violate their previous low. They may well hold. You get that non-confirmation, if you will, a positive non-confirmation, as you will, and as we move into the 9-year cycle low in gold. And then yes, I think miners are going to be probably the place to be versus gold, because the other observation is that when the 9-year cycle is advancing, the miners outperform the metal. When the 9-year cycle is declining, it's the opposite. The miners tend to be weaker, and that's why we saw miners push so low last year. And I think they probably are making their base, but ideally one more push down.
We'll have more with Tim Cyclesman Wood right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's your outlook on oil? It seems to have been trading sideways now for a long time once it topped $50.
Yeah, pretty much the same as with crude oil. I mean, as with crude oil, as with gold. In looking at the commodity complex and the CRB, there should be, because we made that low early last year, there should be a correction toward that bottom, along with gold and the CRB complex in general and equities. The fact that, like I said, just as with gold, the fact that it hasn't really given into that is a positive indication. But at the same time, we do have that cyclical correction that is actually past due, and crude oil has not given into the pressures of that cycle. It's just kind of treaded water and gone nowhere. But I do still look for that push down, along with gold and, the general commodity complex, and like I said, equities as well.
On the equity markets, anything standing out in your mind? I'm just looking at the charge copper has had over the last few months. It's gained almost a third.
Yeah, the thing with equities, it's almost made a fool of everybody that can see it for what they think it is, and it reminds me of a story. I don't want to sound like I'm making excuses, because I'm not. Given the same data, I would have the same position even if I could go back in time, if that makes sense. I mean, I see what I see, and I'm not going to change my story at gunpoint. I mean, I know what I see. And, we had the Dow theory primary trend change back in 2015. We had the decline into the what turned out to be a mild 4-year cycle low in August of 15 on the industrials, occurred in January, February on other indexes in January, February of 16. And then the market pretty much struggled all year until the election, and then it found its way to make one more surge, and here we are. Ultimately, we're going to have a primary bearish trend change to cap it, no matter how long it goes. I mean, if it's already topped, or if it tops in 6 months, or if it tops next week, or if it tops 2 years from now, the bottom line is we're going to have to see that. And until we do, this bubble can stretch more and more and more and more and more. The reason for the caution over the last year and a half so much is because we had that primary bearish trend change in place. It just didn't yield much. Now, that all said, does that change the fact that we don't have that here? Does it change the fact that this is still the bubble that it is? Well, no, it doesn't. And in fact, I don't think most people realize what a bubble it is. I don't think they can see it. If something is abnormal long enough, then, it becomes the new norm. I mean, people accept it, and they start to rationalize and get their mind around a way of justifying it. But if you stand back and look at it for what it is, it's I stand by my statement. It's the largest bubble in stock market history. We all know how we got here. It was driven by liquidity. The chickens will come home to roost on this. I think, when it does, it's going to be ugly, but we have to have the proper setup to cap it. We had that back in 15. We got the decline into 16, and like I said, it didn't yield much. And then it took the entire year of 16 to blow that out, and now it has, and here we sit. And, once we get the next setup, then we're back in the danger zone again. And to give you a little bit of an analogy that I was actually talking about in my February letter, back in the early 70s, and I don't have the text in front of me, I'll just talk about it from memory, but back in the early 70s, there was a tremendous spike in sugar prices. It went from like 1.50 cents or something like that to, I don't remember, it went up 6,000% if I remember the numbers right. It was crazy. And I found this article, and people, over the course of 4 years, took 4 years this happened, people were stealing sugar off of the shelves of the restaurants or the tables of the restaurants. And I found this story that's telling about all this. And it was this tremendous bubble. You look at the chart, and it looks much like, if you stand back, you know, the thing is, we look at a daily chart, and you lose your perception or of where we really are. You stand back and you look at a long-term chart, and you see this hockey stick, this thing just ramping up, and you can see the bubble. Well, that's the way sugar looked. But people, you read the article, and people justified the sugar price, and it's only going to go higher. Just like with peak oil. Remember peak oil in 2008? When it was at its highest high, people were justifying why it's still going to go higher. And as insane and as long and strung out as this equity market is, it's the same thing. And, you know, like I said, we got the setup in 15 and into 16. Nothing really happened. Okay, fine. It hasn't changed a thing. But until we get the setup again, you know, hey, maybe it stretches on.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Any questions for us can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.